This is a demonstration of exercise 16.6b, conversion of bonds. On January 1st, 2020, Desert Windows Corporation issued $1 million of 15-year, 12% convertible debentures at 110. Interest is to be paid semi-annually on June 30th and December 31st. Each $1,000 debenture can be converted into 4 shares of Desert Windows Corporation $5 par value common stock after December 31st, 2021. On January 1st, 2022, $4,000 of the debentures is converted into common stock, which is then selling at $300. An additional $400,000 of the debentures is converted on May 31st, 2022. The market price of the common stock is then $310. Accrued interest on May 31 will be paid on the next interest date. Bond premium is amortized on a straight line basis, and the instructions state to make the necessary journal entries for first, A, December 31st, 2021. So on December 31st, 2021, we will be recording the semi-annual interest payment on the bonds. So we need to calculate the amount that we will actually be paying the bondholders in cash, which is $1 million times 6%, which is half of the annual rate of 12%, and that gives us $60,000 of semi-annual interest that we will actually be paying in cash. The next thing we need to do is to determine the amount of the premium amortization that is done with each interest period. So these were 15-year bonds, so they'll have 30 interest payment dates. So $100,000 is the premium on the bonds. We know that because the bonds were sold at 110. We would divide that by 30 and we would get $3,333 of premium amortization each interest payment period. So that would mean that our interest expense would be the difference between these, or $56,667. The next entry that we're going to be making is on January 1st, 2022. On this date, $400,000 of the debentures is converted into common stock, which the problem tells us is selling at $300. But if you remember, the conversion of the bonds into common stock does not depend on the market price of the shares of stock. It is done at book value. So the first thing that we have to determine is what is the carrying value or book value of the bonds on the date of the conversion. We're only going to be converting $400,000 of the bonds, so that would be our debit to bonds payable. Next, we need to determine what the remaining premium is on the bonds. So the premium for $400,000 of the bonds would have been $40,000. These bonds have been outstanding for two years because they would be issued on January 1st of 2020, and we are at January 1st of 2022. So the remaining premium would be 13 of the 15 years because we would have amortized 2 full years. So 40,000 times 13 divided by 15 would give us the remaining or unamortized premium that we would need to debit for $34,667 because we're removing those bonds. The bondholders are going to receive common stock. So the par value of the common stock, first of all, let's determine how many shares we're talking about. There's $400,000 worth of bonds. Each bond is $1,000. So we divide that and we get 400 bonds. So 400 of the bonds times 4 shares each times the $5 par value would equal $8,000 par common stock. So again, you take the amount of the bonds, divide it by 1,000, and that gives you the number of bonds. Each bond converts into 4 shares. Then you multiply that by the par value to get the amount that you would credit to common stock, which is $8,000. And then you take the total book value of the bonds, which is $434,667. Subtract the par value, $8,000, and then the remaining amount, $426,667, is credited to paid-in capital in excess of par common. The next entry that we're going to make is when we have another $400,000 of the debentures that is converted on May 31st, 2022. And at that time, the accrued interest will be paid on the next semi-annual interest payment date. But we will have to amortize the premium and accrue the interest payable and the interest expense for the $400,000 bonds that are going to be converted so that we can get the appropriate book value. So first we'll determine the amount that we would actually be paying on the $400,000 of bonds. It's been 5 months since the last semi-annual interest payment date, which we recorded at the end of December 2021. So we would multiply the face amount of the bonds, $400,000, times the annual rate, 12%, and then multiply that by 5 divided by 12, because it's been 5 months since we paid interest. So the interest payable amount would be $20,000, and we're going to pay that at the next semi-annual interest payment date in June. The next thing we need to determine is how much of the premium will we be amortizing. So for $400,000 of the bonds times 10%, which was the premium amount, that would give us $40,000. And then we would multiply that by 5 months and then divide it by 180. So the 180 was determined because these are 15-year bonds and there's 12 months in each year, so that's 180 months. And we're trying to get the amount of the premium amortization for 5 of those. So we're going to take the face amount times 10% times 5 divided by 180, and that gives us $1,111 for the premium amortization. So the interest expense would be the difference, $18,889. Now we can record the conversion of this $400,000 face amount of bonds. So that would be our debit to bonds payable. We have to determine again the amount of premium on the bonds payable that hasn't been amortized. So we would take the face amount of the bonds times 10%, and these bonds have been outstanding for 29 months. They were outstanding for 2 years plus 5 months. So that's 29 months. So the remaining premium is 180 minus 29, or 151 months, divided by the total 180 months, or 33,556. Another way to think about that would be you could take the amount that you calculated above for these bonds, 34,667, and then if you had an additional 1,111, that would be the same amount for these bonds. So that's just one way to check it. And then we're going to be issuing common stock. So again, we calculated before what the par value is on the bonds. It still will be $8,000 because it's $400,000 of bonds that are being converted. And then the difference between the book value of the bonds, which is the $433,556, minus the $8,000 par, gives you the amount of additional paid-in capital, which is $425,556. Then the last entry we're going to be making is on June 30th, which is a semi-annual interest payment date. And we're also going to pay the interest payable that we accrued here. So at this point, we only have $200,000 of the bonds left because there were $1 million to start with, and 400,000 was converted twice, so 800,000 total. So to determine the amount of cash that we would pay, it would be 200,000 times the 6%, it would be equal to $12,000. So the cash for this interest payment date for the $200,000 of bonds would be $12,000. But if you remember, we're going to pay the interest payable that we accrued on the $400,000 bonds that we accrued above at May 31st. So we're actually going to pay $32,000 in cash. The premium amortization on the remaining $200,000 of bonds would be $200,000 times 10%, which would give us the premium of $20,000. And then we would multiply that by 1 divided by 30, because there are 30 semi-annual interest payment dates and we're only accruing it for one of those. So that premium on the bonds would be $667. So the interest expense for these bonds would be $11,333. And that would be our last entry. And that is the conclusion of the demonstration for exercise 16.6b.